My name is Tan Kin Lian. I was the former Chief Executive of NTUC Income. I like to share my views on how a young person should invest savings for the long term. The average return over the past 20 years were blue chip shares 9% per annum, corporate bonds 4% per annum, government bonds 3% per annum. My advice to long-term investors is to invest in blue chip shares. These are the shares of the large, well-established companies that are listed on the stock exchange. Many of these companies have been around for 30 years or more. They are well managed and have a steady track record. Investors face the following problems in investing in blue chip shares. Which are the shares that I should buy? These shares are expensive. I will take a long time to buy one lot. The shares are risky. The price can go up or down by a lot, day by day. Instead of buying the individual shares, you should invest in an index fund. The fund takes your money and the money of many other investors and invests them in many blue chip shares. You do not need to worry about choosing which shares to buy. Is this the same as investing in a unit trust? The index fund operates like a unit trust. The key difference is the low management fees. The index fund charges a management fee of 0.3% per annum. Most unit trusts charges a management fee of 1% to 3% per annum. If you are investing for the long term, the unit trust can take away a large part of your earnings. I can choose a unit trust that has more experience and capable managers who are able to earn a higher return, isn't it? Studies have shown that unit trusts, as a whole, have produced a lower return compared to index funds. This is before deducting the fund charges. After deducting the charges, the differences are more glaring. The performance of the funds are also not consistent. Some perform well in the past but perform badly in the future. I'm afraid to invest in shares. In a bad market, I could lose a large part of my investments. You should invest for the long term, maybe 10 years or longer. You will get a bad market in some years, but you will get a good market in other years. By investing over the long term, you will earn the average return. The average was 9% over the past 20 years. Even big companies can go bust. I have read about some of these companies in the newspaper. Will this affect the return on the index fund? When you invest in an index fund, you are diversifying your investment over many blue chip shares. Some of the shares may go bust every few years, but the losses will be compensated by the gains from other shares. This is the advantage of investing in a diversified fund. You are reducing your investment risk. Which index funds should I invest in? How do I make the investment? There are two index funds available in the stock market. They are both invested in the 30 blue chip shares covered by the Straits Times Index. They are managed by State Street and by Nikko. You can choose one or the other. They are quite similar. You can invest in this fund through your stockbroker. Each lot, 1,000 shares, costs about $2,800 now. You pay a brokerage fee of 0.3%. when you buy the shares. The shares are kept in your CDP account. The fund manager will manage the fund by investing in the blue chip shares, collect the dividends, deduct the management fee, and distribute the net dividends to the shareholders every 6 months. The management fee is 0.3% per annum. The fund pays a half-yearly dividend to the shareholders. The total dividend paid out each year is about 2 to 3%. The dividend is credited directly into your bank account. The value of your shares in the fund is expected to grow over the years. You can sell the shares at any time to realize the capital gains. The capital gains and dividend have produced an average return of 9% per annum over the past 20 years. You have to pay a brokerage of 0.3% when you sell the shares. I'm told that the liquidity is low. If I want to buy the index fund, will there be sellers? If I want to sell, will there be buyers? Most of the time, buyers and sellers transact in the market. The fund manager will also help to meet the supply, the market demand and supply. They will create new units to meet the demand. They can also reduce the units when there is excess supply. The return from the index fund has been very attractive during the past 20 years. In the future, we can expect the return to be lower due to global economic factors. But the return from blue chip shares will continue to be higher than bonds. The index fund will continue to be the best asset for long-term investors. Each lot of the index fund will cost about $2,800. If you are saving $500 a month, you can keep the savings in the bank until it totals $2,008. You can buy one lot every 6 months. Here, this table shows the accumulated savings of $600 a year invested over 30 years in the index fund, which is likely to give you $450,000, a unit trust, $366,000, life insurance policy, $263,000, government bonds, $285,000. This is after factoring in the expected gross yield and the deduction. You can see that the index fund gives the best return. Here is a summary. Save 15% of your earnings each month. Keep the savings in the bank account. Buy 1,000 shares of the index fund when your savings has reached the required amount. This may take a few months. Now, I'd like to ask you to tell your friends to register in this website. Click on the Facebook or Google logo. They will receive an email when each video is ready. Thank you for watching this video.